You've probably heard it before: buy low, sell high. Sounds simple, right? But here's the truth. Timing the stock market is one of the most seductive illusions in investing, and one of the most dangerous. Whether you're a complete beginner or a seasoned investor, you've likely asked yourself, is now a good time to invest? Should I wait for a dip? What if there's a crash coming? In this video, we're diving deep into how market timing really works, why even professionals get it wrong, and why you might be better off ignoring the hype. Stick with us, because by the end, you'll walk away with a bulletproof investment strategy that could save you decades of stress and potentially make you a fortune. Before we dive in, hit that like button to help the algorithm spread financial wisdom, subscribe if you're serious about your money, and drop a comment. Have you ever tried to time the market? What happened? Let's start by addressing the big myth. If I can just time it right, I'll beat the market. But here's what history tells us. Even the world's best fund managers, people with PhDs, algorithms, and billions of dollars at their disposal, fail to consistently beat the market. Take Dalbar's quantitative analysis of investor behavior. Over the past 30 years, the average stock fund investor has earned just 4% annually, compared to over 10% for the S&P 500. Why? Because they tried to time the market. And it gets worse. Studies from Fidelity and Morningstar confirm it. Most of the gains in the stock market happen during just a handful of critical days. Miss just the 10 best days in a 20-year period, and your returns are slashed in half. Realistic scenario. You hear the market is falling. You panic. You sell. A week later, the market jumps 8% in a single day. You missed it. Now what? That's the game most investors play, and they lose every single time. If you're investing with platforms like Fidelity or Robinhood, know this. They give you tools to invest smartly, but you've got to resist the temptation to outsmart the market. Use automated recurring investments instead of trying to guess the peaks and valleys. Have you ever sold during a dip and regretted it? Let us know in the comments. Your story could help someone else avoid a mistake. Let's be honest. Why do we even try to time the market? Because it feels good. There's a psychological thrill in thinking you can outwit the system. I got out before the crash. I bought right at the bottom. I knew it was coming. But here's the kicker. Even if you're right once, it's almost impossible to be right consistently. The psychology behind it. Humans are pattern recognition machines. We see headlines, stock charts, and predictions, and our brain creates a false sense of control. This is called recency bias, believing the recent past predicts the future. It's why after a crash, we assume another crash is coming. And after a bull run, we fear we missed the boat. Add in the 24/7 news cycle, Twitter panic, Reddit speculation, and suddenly, we're reacting emotionally instead of thinking long-term. Want to separate your emotions from your money? Try banking with Chime or SoFi, where you can automatically set aside money to invest, round up purchases into a savings or investing account, and set goals that keep you focused on the long term, not the headlines. What's one financial decision you made based on emotion? Let's be real. Sharing helps us all grow. We touched on this earlier, but let's drill down. If you missed just the 10 best trading days between 2002 and 2022, your returns dropped from 9.5% to just 5%. If you missed the 20 best days, you're down to 2.6%. And if you missed the 30 best days, your returns go negative. Most of those big upswings, they happen right after big drops. Exactly when most people panic and sell. Realistic example. Imagine investing $10,000 in 2000 and leaving it untouched. You'd have over $60,000 by 2020. But if you missed the top 20 days, you'd have only $20,000. That's a $40,000 penalty for trying to be smart. Instead of jumping in and out, set up automated index fund investments with platforms like Fidelity, Robinhood, or SoFi Invest. They let you schedule recurring buys and stick to a strategy, no guessing required. Here's the strategy that beats 90% of market timers. Dollar cost averaging. It's simple. Invest the same amount at regular intervals no matter what the market is doing. Over time, you'll buy more shares when prices are low and fewer when prices are high. This smooths out your cost basis and removes emotion from the equation. Example. You invest $500 every month. In January, the stock price is $100. You get 5 shares. In February, it drops to $50. You get 10 shares. In March, it rises to $75. you get 6.66 shares. You've now averaged into a volatile market without ever having to guess. Platforms like Chime and SoFi let you automate transfers from checking to investment. Fidelity lets you schedule recurring contributions to your IRA or brokerage. That's how wealth is built, not by gambling, but by showing up consistently. Trying to time the market isn't just emotionally risky, it's tax inefficient. When you buy and sell frequently, you trigger short-term capital gains taxes, which are taxed at your ordinary income rate, not the favorable long-term rate. Example: let's say you buy $5,000 in stocks and sell for a $1,000 profit in under a year. That $1,000 is taxed like regular income, potentially 22% or more. But if you held it for over a year, you'd pay only 15% or 0% depending on income. If you've been buying and selling frequently, use tools like TurboTax, H&R Block, or Keeper Tax to track those capital gains. And make sure you're not overpaying. Keeper Tax is especially useful for tracking trades if you're self-employed or side hustling while investing. So what does work? The boring stuff. Investing in low-cost index funds. Reinvesting dividends. Staying invested. Using automated contributions. Diversifying across assets. Minimizing taxes and fees. It's not sexy, but it's how people get rich. Warren Buffett says it best. The stock market is a device for transferring money from the impatient to the patient. All of these platforms offer low-cost ETFs, dividend reinvestment options, and tools for passive investing. Skip the next big thing and build real wealth. What's your investing strategy right now? Are you dollar-cost averaging, lump summing, or waiting on the sidelines? Market timing doesn't just hurt your portfolio, it hurts your peace of mind. You're constantly checking charts, headlines, Reddit forums. Your brain is always calculating, should I buy now, should I sell? It's mental exhaustion. Investing is supposed to be a tool for freedom, not anxiety. Let go of the illusion of control and trust a long-term plan. Create financial peace by automating your finances with Chime and SoFi, and tracking your tax situation stress-free with Keeper Tax. Set it and forget it, while your money works for you. Let's look at a few real-life examples. 2008 financial crisis. Investors who sold in fear in 2008 and waited 5 years to re-enter missed a plus 200% recovery. COVID crash of 2020. Market dropped 34% in a month. Many sold in panic. The market then hit all-time highs within months. Dot-com bubble. People bought tech stocks high, sold in fear, missed the rise of Google, Amazon, Apple. Takeaway: market timing isn't just hard, it's destructive. Staying invested and consistent always wins. So, should you try to time the market? If you've made it this far, you already know the answer. What should you do instead? Automate your investments. Focus on long-term goals. Minimize taxes. Eliminate emotion, and stay the course. You'll save yourself time, stress, and likely build more wealth than the average investor trying to outguess the system. Question: what's one thing you're going to do differently after watching this? Comment below. Also, check out the links below to sign up for tools from Chime to automate your savings, SoFi to invest smartly, Fidelity and Robinhood for long-term investing, TurboTax, H&R Block, and Keeper Tax to save on taxes. Your future self will thank you. Thanks for watching. If you got value from this video, don't forget to give it a thumbs up and subscribe for more content just like this. Got questions or thoughts? Drop them in the comments. I read every one. And if you're serious about leveling up your finances, check out the links in the description for tools and resources I personally recommend. Until next time, keep learning, keep building, and take control of your financial future.